Hi everyone, welcome to another video on my channel. Today we are going to look at the multi-asset mutual fund category. The purpose of this video and this channel is to explain the basics of mutual fund in a very easy to understand and very simple words. Uh, the target audience of this channel is basically people who are new to the world of investing and new to the world of mutual funds, and they want to understand the basic concepts of mutual funds. What are the different categories, what are their investment frameworks, and whether certain types of schemes are suitable for them or not. My name is Paresh. I am an NISM certified and AMFI registered mutual fund advisor and distributor. My ARN is 334516. On the right hand side of every slide, you will see a QR code. You can scan the QR code using your phone camera, download the Funds Bazaar app, and start investing in mutual funds. You can also click on the link which is given. Both the QR code link and the website link is available in the description to this video. Um, yes. So before we move on, this is the standard disclaimer. I will leave you with this for a few seconds. The gist is that mutual fund investments are subject to market risks, and you need to read all scheme related documents carefully. Past performance of any mutual fund scheme does not guarantee or in any way indicative of its future performance. Right. So when a new investor enters the world of mutual funds, the first thing that they notice is that there are just too many fund categories. If you go to a mutual fund website, there are probably 50-60 different types of schemes: arbitrage fund, flexi cap fund, hybrid debt fund, mid cap fund, focused equity savings fund, uh, ELSS, multi cap, right? uh, Small cap. So what are these different fund categories? The purpose of this channel is to take most of the popular categories and examine them one by one, trying to explain in simple words what they mean and what kind of investment needs they satisfy. So, what are multi-asset funds, right? So, an multi-asset fund is an open-ended hybrid mutual fund scheme that invests in at least three asset classes with a minimum allocation of at least 10% each in all three asset classes, right? Foreign securities are not treated as a separate asset class in this kind of scheme. So this is the you can say the official definition. Remember that multi-asset fund is a hybrid mutual fund. What is a hybrid mutual fund? Which combines two or more asset classes. In the previous video, we saw flexi-cap funds. We understood the basics of flexi-cap funds. A flexi-cap fund is a pure equity mutual fund, right? It's not a hybrid fund. I mean, the fund manager might want to invest uh, some part in money market securities, uh, uh, but it's not a hybrid fund. But a multi-asset fund is a hybrid mutual fund. It's a small technical differentiation, but it is still important to be noticed. Okay, so I'm sure you have multiple doubts about this definition. The first is that what is an asset class, right? So an asset class is basically a group of marketable financial assets that have similar financial characteristics and behave similarly in the marketplace. So these are typically traded in the same financial markets and they are subject to the same rules and regulations. So equities, which means company shares, right? Listed company shares, they are traded on BSE and NSE in India. They all have the same rules and regulations when it comes to buying and selling of shares, or any other operations when it comes to listed equity shares. So the examples of various asset classes are equities, which means company shares, listed company shares. uh, they could be unlisted company shares also, but for mutual funds we are only looking at listed equities. There could be debt or fixed income. So the various companies issues bonds. Bonds is what basically it's similar to a fixed deposit of a bank, wherein you get a guaranteed return. Uh, and real estate is also another asset class. Commodities like gold, silver, copper, they are also traded, right? So there are commodity exchanges wherein these commodities are traded, and currency like USD, US dollar, INR. Uh, so this is a brief description of an asset class, right? There is a lot of financial theory behind this. academic theory on this, but this is in very very simple words what is an what an asset class means. Right? So why choose multi-asset funds? Right now that we have understood asset class, and now that we have understood that multi-asset basically combines different asset classes, at least three asset classes. So why? What is the appeal of multi-asset funds? One is diversification, right? So different asset classes outperform at different times. This is the most basic concept when it comes to combining different asset classes. So equity typically aims to provide growth, right? So when markets are outperforming, it's the listed equity shares that will always give better returns than say debt or even gold and silver for that matter. The debt component aims to provide stability, and gold, silver, or any other commodity basically aims to act as a hedge against inflation and currency depreciation. So inflation, currency depreciation, these are two factors which typically eat into your returns. Right. Again, this is a complicated topic, but let us take a recent example. Right. You must have seen that during the tariff tantrums, when Trump first announced the tariffs, markets all over the world crashed, including Indian markets. This was in April, right? April, March, April, May time. But gold, if you have been following the news, right? Gold prices have surged. Silver prices have also surged. Why? Because gold typically acts as a safe haven, not only during market turmoil, but even during geopolitical turmoil. What are geopolitical turmoils? Things like wars, right, or famines. Ukraine war, right? Russia-Ukraine war, India-Pakistan war. Gold prices have been rising because gold is seen as a safe asset. So whenever there is too much uncertainty in the world, investors typically abandon equity and even debt to a certain extent, and they flock to gold. So that is the diversification aspect. The idea is that different asset classes outperform at different times. So when equities were down, gold was surging. So by holding both equities and gold, you could probably average out your overall investment returns. If you had 100% in equity, for those 2 or 3 months, you would be underperforming, right? Because there is no other asset class in your portfolio. But if you had a balance of say 70% equity and 30% gold, even though that 70% equity portion underperformed, the 30% gold would have outperformed because gold has surged like crazy in the last few months. And your overall return, if not positive, it would have been slightly negative as compared to say a full equity portfolio. Similarly, debt aims to provide stability. There is some sort of a fixed return expectation when it comes to investing in debt, and it can also balance out the the negative returns that are provided by equity. So pay close attention to these three components because these are the basics. Equity is always looked at as a growth asset class. If you really want to get returns which beat the inflation, there is no option to equity. This has been proven for as long a period as say 70 to 80 years, almost since the Great Depression. Equity over a long period has always outperformed any other asset class, including real estate. Right. So the second point of choosing multi-asset funds is risk management. Different asset classes have different risk return profile and correlation. What is correlation? This is a technical statistical kind of a term. We will come to it in the next few slides. Third important point is that multi-asset funds are comparatively less volatile than pure equity funds because you are combining different asset classes which have a different risk return profile and probably negatively correlated with each other. These three or four different asset classes will not move in the same direction. That is why if you have a pure equity fund versus a multi-asset fund will always have a less volatility. What is volatility? When the market moves up or down, how much that particular fund or scheme moves up or down. Right? If market moves down by 20% and your pure equity scheme moves down by say 20 or 25%, a multi-asset fund would typically not go down in value by 20 minus 20 or minus 25%. It will probably go down depending on the different class allocation. It will go down maybe 10%, 15%. Right? So let's look at the performance of different asset classes over the last 23 years. This is the data for the Indian markets, right? So we have looked at the data from FY 2003 to FY 2025. So 23 years is a very, very long period, and I would say sufficiently long period to see certain trends. Now look at this, right? In FY 2003, equity gave minus 12% returns, which means if on April 1st, 2002, if you had put in 1 lakh rupees in the market, by 31st March 2003, that would have reduced to approximately 88,000, which means you would have lost around 12,000 rupees in equity markets. But debt gave a return of 14%, which means if you had invested in debt, you would have actually got 14,000 rupees. If you had invested 1 lakh in debt, you would have probably got 14,000 rupees at the end of the financial year. While gold, you would have probably got 9,000 rupees. So that is the profit I'm talking about, right? So this is one example. Another example is another financial year which ended in March 2009. Equity gave minus 35 returns, debt was 12%, gold gave 27% return during that financial year. Another, right, March 2020, this was equity gave minus 25%, debt was 12%, gold was 33%. Now if you look at all of these years, take some time on this slide and understand how these returns are moving, right? None of them are all positive. I mean, there are rarely all positive, and whenever one asset class is negative, the other two will typically be positive. So that is the idea, and especially look at equity. Whenever equity has given negative returns, debt has given higher returns, and gold has given higher returns, right? It is very rare for all three asset classes to give negative returns at the same time during the same period. That is the entire idea behind combining these different asset classes, so that no matter what happens, right, uh, the performance will be balanced out depending on the allocation that you have to these three different asset classes, three or more. In addition to gold, there could be silver, there could be real estate, there could be copper, you name it, right? So this is a very, very interesting table, and this will probably give you an idea of why multi-asset funds are less volatile than pure equity funds. So multi-asset funds combine negatively correlated assets. Now we will come to the discussion of what is a correlation on this slide. Now, correlation is a statistical concept, right? Uh, Correlation looks at how two different variables move in relation to each other. In when it comes to asset classes, asset correlation is a measure of how asset classes move in relation to one another over a period of time. Correlation coefficient can range from -1 to +1. What does that mean? If correlation coefficient is positive between two asset classes, it means they move in the same direction. What to what extent do they move? That depends on the correlation coefficient, right? So if you look at the first row on the table over here, equity to equity correlation will always be 1. Why? Because it's the same asset class. But equity to debt correlation is 0.08. So they are still positively correlated, but if equity goes up by 100%, debt will only go up by 8%. That is what is meant by this, right? But equity and gold, they have a negative correlation. What does that mean? When equity goes up, gold will typically fall, but when equity falls, gold will go up, right? Similarly, debt and gold also have a negative correlation. So when debt falls, when the return from debt falls, return from gold will go up. So this is again around 20 years data. So the basic idea, right, of combining negatively correlated assets is that by combining these negatively correlated assets, investors can reduce risk and the volatility of their portfolio. This yellow color box that you are seeing, at the bottom, that is the entire gist in one sentence of what multi-asset funds aim to achieve. I think there is a slight typo over here in the source, right? So this data is from April 1, 2005 to June 30, 2025. So this is for around 20 years data. I hope you have understood the basics of multi-asset funds, and the asset classes therein are negatively correlated. So how has multi-asset fund as a category performed over the years, right? So here, as I told you earlier, multi-asset funds fall under the hybrid mutual funds category. These are some of the prominent, hybrid mutual fund categories. And look at the highlighted row, right? Multi-asset allocation funds. This is the average category performance over 10 years. They have returned around 10.2% annualized return. This is the annualized return, right? Over the last 5 years, they have returned around 15.73%. This is a very good return, right? 10 years, 10.2%. Yes, you must have remembered from the last video about flexi cap funds. Flexi cap funds typically, gave around say slightly more than 12% returns. So as per industry norms, whenever you are projecting, your future corpus, or you are deciding what is the right SIP amount to invest based on your future goals, 12% is taken as the rate of return for pure equity mutual funds. But hybrid multi-asset allocation funds are given around 10.2%. This is a very good performance. And again, a disclaimer here: past return is no guarantee of future returns. The disclaimer is there at the bottom of every slides, but I'm just still pointing it out. Also, another thing to note here is that this is the average category average, right? So there will be funds in this category which are given more returns than this, and there would be funds which are given less returns than this. So we will look at some well-performing multi-asset funds in this category. So these are some of the well-performing funds. Look at ICICI Pru Multi-Asset Fund, probably the highest AUM in this category, 62,000 CR, and 10-year return of around 14.8%. Tata Multi-Asset, Quant Multi-Asset, HDFC Multi-Asset Fund. So this is the kind of returns that they have given. If you compare them with pure equity funds, these returns will always be lower. Why? Because this is not a pure equity fund. It is combining debt, it is combining gold, and probably a few other asset classes. But the volatility is lower, and so this is the risk return trade-off that you have to take in the market. If you are willing to accept higher risk, you go into pure equity. Even within pure equity, there are multiple categories which are uh, you know uh, different on the risk spectrum. But if you want to play it a little safer and kind of want to reduce the volatility and combine multiple asset classes, these are the returns that you can expect. So let's look at the asset allocation in multi-asset funds, and let's look at how ICICI Prudential Multi-Asset Fund has allocated its assets. So this is from their disclosure, and if you look at the June 2025 column, right? So gross equity is 68%, net is 2054. There is gold, they are around say 4.9% of gold, 4.3, 4.4% of silver. There is REIT, INVITs. So this is the real estate investment trust that I talked about. Copper, crude oil, aluminum. Aluminum has no allocation in the last say 6 months or so. So this is, and debt of around say 22%. So this is why it's not a pure equity fund. It has allocated across multiple asset classes, and that is why it is this kind of category kind of shields you against the volatility in the equity markets by combining negatively correlated assets. Important point to note here, right? Although these are not pure equity funds, multi-asset mutual funds are still categorized as very high risk, as per SEBI categorization. I just thought it is important to point it out. Although yes, the volatility and the risk is slightly less than pure equity funds, but as per the SEBI framework, they are still considered as a very high risk. So that was about multi-asset allocation funds. So if you are a first-time investor, right, investing in mutual funds is a fully online process, right? There are you don't have to submit any Xerox copies. There are no forms to be filled, nowhere to be signed, no passport photo submission. It is an entirely online process. All you need is your Aadhaar card number, your PAN card number, and the cancelled check of the bank account from which you would be investing in mutual funds. What do you do? How do you invest in mutual funds? You just scan the QR code on the right using your phone. Download the Funds Bazaar app, or you can click on the link given in the video description. It will take you to the Funds Bazaar website. All you have to do is enter your name, your mobile number, your email. You will get two OTPs, one on your mobile number, one on your email, so that your email and mobile numbers are verified. Once you do that, there is the basic KYC. You have to submit your PAN number, you have to submit your Aadhaar card number, and then upload a copy of the cancelled check. During this entire process, if you find any problems, or if you need any help in terms of getting your KYC done or registering on the app or on the website, or if you need any help in terms of what is the right mutual fund scheme for you, whether multi-asset allocation fund is right for you, or whether flexi cap or any other type of scheme, you just have to drop a hi on WhatsApp on this number 975730929. I am a registered AMFI registered mutual fund distributor and advisor. I would definitely help you in selecting the right mutual fund schemes based on your risk profile, based on your investment horizon, and based on your financial goals. So this was in a nutshell about the multi-asset allocation funds. Keep watching this channel, wherein we will cover many other mutual fund categories and various other basic concepts. I wish you a happy, successful, and prosperous mutual fund investment journey. Thank you.